Right. So we're starting our session again today. So what we did, I have kept a document. By the way, the question that Siddharth asked at the end, I put in a link to chart school here and also in your notes file if you want to inquire about technical indicators. It's there at the end of the video, in the last class, for the last class. Okay, this is a good source of information. Be careful because use only the sources that I've given you because there's a lot of rubbish on the internet. You might actually get wrong information. So use this and use the Barry Kaufman book in your finance reference folder for further knowledge of TA. Okay, so here we are. This is what we had covered the other day. All right, so we are on the plan where we are trying to map out a technical. So we looked at the various ways to solve the buy-sell decision problem. And then we looked at FA versus TA. Then we started looking at, because you're doing your project, we wanted to at least give you a comprehensive trading system using TA and how you use a trading system, which is basically a set of rules for solving all your decision problems. Okay, so now we have been going through them. So we have comprehensively solved the buy-sell bias problem. We have here a, we open the, open this as well, and that's where we find the trading system at the end. Okay, so we are looking at the trading system and we are looking at how it helps us to solve all these different decision problems. And that's where we were, a simple trading system using TA. That should hopefully give you a lot of structure in the way you do the project. All right, so this is where we have already covered using the trading system. We have given you two methods. We've given you two methods for, I mean, either you approach it as a momentum trader or as a mean reversion trader. We have given you very clear-cut rules covering all situations, where and what you're going to do in each of those situations, whether to buy or to sell, or not to do anything. All right. So all these things have already been covered. And then in the last session, what we also covered is the, let's come back to a ticker, which is in our, so we'll come back when we need to keep looking at Facebook for a while. Okay. So we came back to the, we have covered these two, which means basically it covers this decision problem for us. Now we know how to solve this DP using TA. Okay, notice how simple the solutions are. And then we also discussed in the previous session, as I've tried to document here, the rules for, this was yesterday's session where we had, we discussed all this. So these are the points we discussed. We talked about the immunomedics event and the price gap and all that. And then essentially we discussed the stop logic. Okay? The stop logic essentially is talking about this other decision problem. So remember, in our minimalistic trading system, we have these three already decided by the investor mandate. And then we only have three other problems to solve. And you can see how we have an extremely simple trading system that is nevertheless quite comprehensive. Okay? So that next problem, one of the other important problems that we have to deal with is the 6.2, which, as I told you, which is not an impression that you will get from reading academic research, but this actually is, if you think about all the decision problems, this is actually the most important decision problem, where you exit, especially with a loss. Okay, this includes the idea of the stop order. So you'll understand this later on as you go through. You gain more trading experience. All right. So this is the other one, and we covered the stop logic as well, so that I don't have to spend a lot of time on the stop logic today. All right. What I'm going to do is just briefly tell you, because in order to deal with these, problems, okay, Um, all right. Now, in order to deal with these problems, we have, in order to deal with these further problems which are critical to the minimalistic trading system, we will just call it a bare bones trading system. We need to make certain assumptions about how this one has been solved, the DP5 entry price decision problem. Okay. So what we are going to do, as I've said, this is not a part, we're going to actually remove this from the bare bones trading system because we want to make it simple. So what we are doing is how do we remove the, so DP4 is already done. Now, put stars over. One second. Okay, so I put a star here. Next is DP5, right? Now, DP5, notice the DP5 is the question of after having decided your buy or sell bias. Let me just show it to you as Facebook as well. Now, if you decide that you are a buyer here, just as an example, if you decide that you're going to be a buyer here, just looking at this long-term weekly chart, you still have a further decision to make, which is at the very least. So when we look at the decision problem number 5, let's see, it's open. Okay, we don't have the 5 open, so I'll just open the 5 also here. So as I said, we are discussing this, although we don't treat it as a decision problem in the minimalist trading system, because we are going to force you to choose only one solution every time for the minimalist trading system. And later on, when we make the trading system a little more complicated, then we will allow you multiple choices in the solution to this problem. Okay? So the reason we are removing this problem, if you look at this, how it is laid out. So what we were saying, that if you are here, right, and you have decided, now obviously it's pretty clear if you're a momentum trader, all these are high, higher, high, low, higher, low. Even if you look inside this thing, there's an uptrend going on. So you are obviously, as a momentum trader, you have a buying bias, but you still have another decision to take if you're just focusing on this part. Or maybe let's take we can take a 5-year. This is the 5-year, okay. So we take a 1 year, okay. Even now it's, you can see here, you still have to take a decision if you're a buyer, okay. Whether you're going to enter immediately at this point at the market using a market order, or do you think that it will come down maybe to 220 or something like that, okay. So if you think that, then you would not buy immediately, you would wait for it to decline, okay. So you have two basic choices, which is to use a market order and enter immediately, or to use a limit order and enter at a more favorable price. So this is what we have laid out here in the DP5 solutions, okay? So ordinarily we talk about the DP5 decision problem as the entry price decision problem as after having decided the buy-sell bias, there's still a decision to be made as to whether to enter immediately at market or to wait for a better price. Initially, we are talking in simple terms, but actually to be comprehensive, there is also another kind of entry, which we will not immediately discuss. So, which is that entering through a stop order, in which case you enter at a less than favorable price, okay? So in this case, a stop order would be, market order entry would be right here, okay? Immediately entering at the current market. So a limit order entry might be something like, okay, I think it's going to come to 220. So instead of placing a market order, I will place a limit order to buy at 220. Okay, that's the second option. The third option is to say, well, I'm not really confident. Looks like, yeah, there is an uptrend, but I'm not 100% confident. So what I'm going to do is I'm going to wait for a new high to be made. If a new high is made, then that is confirmation that the uptrend is continuing. Okay, so you can say in the smaller time frame, there is a high. In the smaller time frame, there is a high, and you can see there's a slight neutralization of the uptrend here. So therefore, what you say is now I'm suddenly not so confident. I'm not. There's a neutralization here. This low is broken. When you look at the smaller patterns, and so you say that, well, I'm not so confident. Maybe I should wait for the market to indicate to me that uh, the uptrend is still continuing. Okay, that it has not ended over here. Okay, so I want the market to prove that to me, and then only then am I going to enter. So in that case, what happens is, so essentially the market has to establish, to prove to you that the uptrend is continuing. So remember the characteristic of an uptrend: higher highs, higher lows. So maybe it stays above this, okay? Maybe stays above this as falling, comes to 220 maybe, or stays above this, and then eventually makes a higher high. This is the all-time high for Facebook, okay? Around 305, the all-time high. Now, as it goes to a new high above 305, what you have is a pattern of this low would not have been broken. It will only come to 220. Okay, so you had a higher low, low, higher low, higher low, another projected here, and projected new high above 305. So once it goes above 305, okay, without breaking through this low, it clearly establishes that, the doubts that you had at this point, where you were not so sure as to whether the uptrend is still intact or not. I mean, is it still in progress, or has it already ended at this point? That doubt is now removed, because if it makes a new high, that means the uptrend is continuing. Okay, so that is the kind of mindset that would lead you to place a stop order. Okay, so we have pretty much covered DP5 already. Okay, which is probably also a good thing, because you guys are trading in your project right now. You need to have some kind of idea. So this is essentially what it is. Although Facebook is not one of your tickers, doesn't make a difference. You understand the discussion. So you have a bias, but you still have to decide, should I enter at the current market, in which case you use a market order. If you do you want to enter, do you think this is going to come down a little bit more? In the case of a buyer, okay, so you would enter at a more favorable price. Obviously, this 255, whatever it is, okay, 253. 253 is not as favorable as 220. If you can buy at 220, it's much more favorable. So that's a limit order case, which is the second case, okay, limit order. And then the third one, which I just explained to you, which is a little unconventional, okay, which is entering through a stop order. We'll come to that later on if we want to further discuss this point, but I think you pretty much already have a good understanding of this DP5, all right? So you can practice this in your, as you're doing your project. This is what you should do, okay? So, so remember that if you're a seller, if you flip this around, look at something like maybe GE, let's say for whatever reason you want to sell, okay? You think that this is not going to be exceeded and it's going to keep on going lower. And if you feel that, right, you feel this is going to go down and this will not be crossed, but right now GE is around $7, but you think that GE is going to come to $8, right? So then you would actually leave a limit order to sell at this price, okay? And notice the language that I'm using. That's why I've told you, be very careful. The notes that I'm giving you, these are all theoretical, constructs, and you have to be very particular about the use of words. You notice that I am using words like more favorable. I'm not saying lower than or higher than, because if I say lower or higher, that becomes tied to the long or short side. But if I write more favorable, then it's very general, it covers everything, okay? So when you talk about limit orders, when I was showing you Facebook, I was showing you an entry price lower than the current market, because we were talking about a buyer. Now when I'm showing you GE, we are talking about a seller. So I'm showing you an entry price through a limit order, which is higher than the current market. So that's why I don't use words like higher and lower here. I say more favorable. But both cases are more favorable because if I'm a seller, it's better for me to sell at 8 than to sell at 7. If I'm a buyer, it's better for me to buy at 220 than to buy at 253 on the Facebook chart. So that's what is meant here. So be very careful. We understand why I've used this term favorable. And less favorable, you understood if you go back to the case of Facebook, okay? Or you can even apply it here to get you used to it. That if you're not so confident here about GE, you think it's going to go down, but you're not so confident. You want to wait for a little more confirmation, okay? Kind of like what Vipul was talking about earlier when we talked about neutralization of trends. He wanted to wait for the mean reversion entries, and we called it a kind of like almost a conservative approach to mean reversion, but it's not really that. But he was saying, let's wait for another new low to be made, and then only will I go short. So here you would have similar ideas. I'm not so sure whether G is going to go down, but you're leaning towards the bearish side. So instead of going short here, the market order, going short here with a stop order, with a limit order, you decide to put a sell stop. Notice that this will be called a sell stop. Stop orders are either sell stop or, because we're not discussing DP5 in detail, although we are already spending a lot of time on it, okay? So maybe I should put a lot of asterisks here. Let's take this here. But this is true of everything actually. Okay. All these three orders basically have the all three orders and basically all order types almost. Okay, so what I mean to say, I mean, the language here is not so elegant, but what I mean to say is when you're entering a limit order, you will have to enter as buy limit or sell limit. When entering a stop order, you have to enter it as buy stop or sell stop. When you're entering a market order, it has to be a buy market or sell market. That is obvious kind of, but I'm still clarifying it because we are using this language. So in the case of GE here, when you want to wait for a continuation of this downtrend as a confirmation before you go short. So you don't sell here with the market order, you don't sell here with the limit order. You put a stop sell, you put a stop sell, sell stop, or sell stop is a better way to do it. You put a sell stop here while the market is here. So that's why we say that the stop order is always going to give you an entry, the stop order, entry at a less favorable price. Here, less and more are relative to the market. Okay? Obviously, less and more have to be relative to something. Okay? So less and more here is relative to the market price. So the entry at using stop order is always at a less favorable price. Why? Because the market is 7 and I'm placing a sell stop at 6, say just under 6. So if I'm a seller, it's obviously less favorable for me to sell at 6 than to sell at 7. So therefore less favorable. So same thing here, it will be a sell stop. In the case of Facebook, if you go with a buy stop here, that will be a buy stop at 305 or 306. And obviously, it is much better to buy at the current market of 253 than to buy at 306. Okay, so although I did not want to discuss DP5 in great detail, I have actually discussed it in pretty extensive detail. Now you have a good understanding. But the important point is that for our discussion, okay, So in your actual trading in the project, you can use any of these entry methods. Okay. But what we are trying to show you is that in a minimalist trading system, we don't actually need to treat it as a decision problem. How do we do that? What we are doing is the DP5 is what we are attacking next, which we just discussed. I'm removing this decision problem. Okay, how do I remove the decision problem? I just assume that this is always solved for the moment, okay? I mean, not that you have to do it in real life when you have a more complex system, but since we are designing a very simple system, I want to reduce as many DPs as possible. I want to have a very, very bare bones trading system. And so in that first phase of the design of the trading system, I'm actually saying that we don't need to break our head over this one. We don't need to break our head over, should we do this? Should we have market limit, stop, which one? We don't need to break our head over this. I'm going to remove this decision problem. I'm going to assume that it will always be solved, okay, at market price. Okay, so if I force you to do this, if I give you this rule that everything has to be always entered at market price, then you no longer have a decision problem. Okay, understand that a decision problem only exists when there are multiple choices and you don't know which one you should take. Okay, you're a little confused, and so you need to take a decision. But if I've already made it clear to you that all entries should be at market for the current, for the purposes of the bare bones trading system, then you no longer have to scratch your head over what to do for this one. You already know the decision. It's always market order. So that's what we are doing. We are removing this decision problem by making an assumption about how it will be solved, because we need to make an assumption in order to move on to the other decision problems. Okay, so this one is clear. Any questions about DP5 at this point so far on the discussion we've had? Okay.
Sir,
Yes.
sir, does retail investors play a role in this DP5 problem?
Retail investor, I don't understand your question actually, but the point is, let me just make one important point along the way before I get to your question once again. But this, like we often have discussions when we have discussions with the faculty on the curriculum and all that. One of the points that Indira makes is that the students should, have a good understanding of at least how to manage their personal portfolio. So what I would say to you here is that everything that we are learning here, okay, I'm actually training you to be institutional traders. Institutional trader means that you go and trade for SMC or HDFC mutual fund or Morgan Stanley or somebody like that. So as an institution, as a financial institution, not as Vipul Garg trading for his personal account. But the point I'm trying to, I think you should remember is that everything you learn as an institutional trader, when you trade as a, say when Vipul is trading as an institutional trader for SMC, or he's trading as a personal trader for himself, there is no difference at all in the principles that he's using. Absolutely no difference. Everything is at 100% the same, okay? So all the decision-making tricks that I'm teaching you, although I'm training you as an institutional trader, but when you trade your personal portfolio, you are going to use exactly the same principle, 100% identical. The only difference that's going to happen is if you go back to your, if we take your notes and bring it back here. All right, so here we have, this is your calc file. When we were talking about this, so only thing that's going to differ, I want to use this question to make this very important point in case there is any doubt about it, that the only difference that's going to happen is as a personal, when you're trading your personal account, so that is likely to have less investable capital and less risk capital. So therefore that naturally maximum risk per trade will also be lower. and therefore naturally your position size will also generally be lower when you're trading your personal account, because you are unlikely to have as much money as when you're trading for an institution like HDFC or IDFC or whoever. Okay, so that's the only difference. Now, so please make sure that everybody understands that. So don't say that, oh, sir did not teach us anything about how to manage our personal portfolio. No, the exact same principles will apply. Absolutely 100% identical. Okay, only difference obviously is your money is less, so the size of positions, but the principles do not change. Okay, I hope everybody understands this point. Okay, now coming back to Vipul's question, I didn't really understand what you meant, but
Sir, I'm saying that suppose, sir, in a particular stock, sir, there are more investors. Sir,
okay,
then the volume of the stock will increase, trading volume.
okay.
Sir, that will affect the price or not affect. I want to ask this.
That
Trading.
that will affect the price in what way?
Sorry, suppose, sir, sir, like we trade, sir, it shows that a total volume traded in a day
Yeah,
of both, sir, buying and selling.
yeah.
Sir, I'm asking that if the volume is high, sir, the stock will affect in a positive way, or it will not affect the stock.
No, see, volume, if you read, I think Siddharth also had asked a question about volume earlier. Volume in general, okay, so you have a question here about volume actually. You're talking about volume. Earlier you were talking about retail investors. So what is the
Sir, because, sir, if retail investor increases, sir, then the volume also
okay,
of
okay,
a stock
okay,
increase.
okay, got it, got it. So I would just treat this as a question here. Okay, so let me just say, I'll just give you another opportunity here. So yeah, retail investors can, okay, volume confirms the trend. This is the principle. Okay, you can read more about volume. I don't remember. I think it's chapter 12. Read the. If you go to the Perry Kaufman book, there's a book by Perry Kaufman which is there in your finance reference. And if you check with Siddharth, I had given him a response in the volume in the chapter number. I think the chapter is 12. Chapter 12 is you can find the chapter. Okay, there's a chapter on volume in the Perry Kaufman book, and you can read that. But I'll just give you the general principles. A volume confirms the trend. Okay, so if we have, let's say, on Facebook, if you want to use, let's say, 1 year. So generally, what we say is the indicators. If we want to look at indicators, somebody is not on mute. Actually, the background noise is coming in. Okay, so if you want to look at volume, okay, I don't know if this is the actual volume that they have. Okay, yeah, you can see this. So normally what happens is when we track the charts, we usually, especially in terms of stocks or futures, spot stock contracts or futures contracts, you can get volume data from the exchange traded markets. It's easier to get volume data. So what we do is we look at volume, and what we say is that volume confirms the trend. So generally, volume confirms the trend, which means that uh, any move uh, occurring on high volume, let's put it this way, low volume, low volume is seen as more less reliable or likely to continue. By reliable, we mean, let me put this in brackets, reliable is likely to continue. Okay, that's what we say. This is the general principle. Okay, so when we have any here, you can. So typically, how we how we chart the stocks, chart stocks is like this. So you can see here that there's a day on which there's a lot of decline in Facebook. This is pretty high. Okay, so you have generally what happens is, then you see here another day on which you have a big high volume up day. Okay, So they have basically shaded the volume bars with, if it's a down day, it's red, otherwise it's in cyan, okay, if it's an up day. So you'll have some kind of color coding in most of the charting systems. But the general principle to remember is that as a uptrend is developing, not so much looking at one day's volume, but general trends of volume, average volume, etc. So generally what you want is, if this uptrend is likely to continue, as the uptrend is developing, you want to see at least volume holding steady or increasing. If that is happening, then you think that, then you would conclude that other things, ceteris paribus here, of course, other things remaining the same, you would conclude that this move is likely to be sustained. Okay? If it is happening on low volume, then you would be suspicious and you would think that this is not likely to be sustained. So when those are those who trade from a mean reversion point of view, okay, momentum traders can use it. When they are trying to go against a trend, one of the things they look at or they look out for is price is going up, but actually volume is going down, right? So they say that, okay, this trend is not likely to continue because it's not being confirmed by the volume pattern. Okay, so basically, volume confirms the trend, which means any move occurring on high volume is seen as more reliable. Reliable means likely to continue, and low volume is seen as less reliable. Okay? So low includes the idea of declining volume. Low or high includes the idea of high or increasing volume, and low or decreasing volume. Okay. So this is the answer. Now, does that answer what you were looking for before?
Yes, sir.
Okay. All right. So we'll put this as a italics thing because it's not in as part of the flow of the discussion. Okay. Now, so what we have done is we are in the process of designing our bare bones trading system. And we already had a fairly extensive discussion on DP5, but we don't treat DP5 for the simple trading system, which I'm going to use in future now to indicate bare bones or minimalist. Simple trading system, we don't even treat this as a decision problem because we say that these three options, you're always going to choose the first option and always going to enter everything at market. You need this assumption because when we come to 6.2 and 7, we need to have some kind of assumption. We need to make an assumption about how this one is solved, because without some kind of a concrete assumption, we can't solve these. Okay, so these are all interdependent. So we've made that assumption now. Now we'll move on to 6.2, which we've already covered actually. 6.2 essentially is the stop logic. Okay, exit price with loss. So essentially it's the stop logic, which we have already covered in the previous session. Okay. So we have already covered previously in the last session the stop logic. We had an extensive discussion about immunomedics and with many other examples of charts, but we'll repeat it once again. Okay, that now we're going to talk about the 6.2 solutions. Okay, we're moving through each of the solutions. So let's go to 6.2. Here, exit price with loss. So the question here is, the decision point here is, let's say we go back to, I'll try and remove this. So let's go back to one of the tickers that's in your list. Okay. So here you have FCX. This is 1 year. So long-term trend is up. And another thing that is interesting that you can do is when you have companies like this, you can also start tracking it as part of your learning. Okay, so you can see how you can learn through this project. Like you discovered here yesterday, we knew that at least Siddharth has followed the news of the immunomedics merger. Okay, so you can actually, there's a copper, I'm looking for a copper CFD actually. But okay, let's do the current contract, next contract. Let's do the current contract. Now you see this is a copper contract, continuous contract. Now very interesting, do you notice the similarity between FCX and copper? Okay, so let me do a compare add symbol. Let me do FCX. Okay. There's never Freeport McMoran. They used to be called Freeport McMoran copper and gold. Now you see that there is a fair amount of similarity. Now this cannot really be quantified in a way that you can rely on it, but at least from the point of view of learning your theory, this is part, now we're talking about fundamental analysis, okay, because this is a company's copper producer. So we are now watching the extent to which, so this relates not so much to the actual execution of your project, but the learnings that you can derive from the project. These things are, learning is all based on how much effort you put in. So, but I'm just showing you one of the ways you can study these companies, because you can learn a lot by reading up on these companies, and that becomes part of your FA. So this is now FA type of thinking, where you would try to, now we are moving away from TA and back to FA. So you would look at the copper price, okay, and you would look at what is happening to the copper price, and then look at the FCX price. And this is actually, the red one is the FCX price, and this is the copper price, okay. So you can see that there is some element of similarity. You can see here this decline, kind of this decline, and then this is going up again, okay. So now if you see here, yeah. So you have this movement, you can see the correlation between the two prices. And so this is one of the ways you can study different companies. We're not going to spend too much time on this, but I just wanted to give you this kind of an idea that in cases of companies which are dealing in commodities, like copper producers, gold producers, one of the ways you can look at those companies is to start comparing it to the actual product price. Okay. Similarly, if you had the data, you don't have that much data, you could also look at the Apple stock price, comparing it to iPhone units sold and things like that. So that becomes all part of FA, right? So just wanted to give you that idea. We'll just remove the other. Oh yeah, I know, understand what happened. Yeah, this is a copper price actually, because I came up with FCX later. So let's move this back to FCX. Right, so 1 year is up, okay. 3 months is also up. And just as to understand, before we get into our discussion, I'm highlighting the level of zoom that I'm applying. I'm not looking at all these small lows. I'm looking at one, whatever the low has come from before. High, low, high, high, this high, and this high. And the lows are whatever this one was, and then this one, this one, this one, and this one. Okay. I'm not looking at the smaller patterns, like there's another low here, another here. Another. I'm not looking at that. So the zoom level is slightly higher. This is the last low. So now, if you see, now let's see, I think you guys can read the, now let's, the question is basically, what is the question we're dealing with? We are dealing with the DP 6.2. That from the rules that we have given, let's take the case of a momentum trader. From the rules that we have given, where we check for, first we look at the trading time frame, we see an uptrend. We see that the trend is already, the uptrend is intact, which means this leads me to have a buying bias. But now I have to check the long-term trend to make sure that I'm not going against the long-term trend, which is the other part of the rule. This is the first rule. Yeah, I check the long-term trend. Long-term trend is also up and is also intact. Okay, so I can now. So now the question is, so I go back to my trading time frame, so I can actually enter my long position, and now we bring in the DP5 automatic solution for the moment, which is it's always solved with the market order, which means I enter at, say, whatever, let's say $17. I enter at $17. Now my question, now we have one more problem to solve, which is, so if I have already solved this one, I have solved this one by making an assumption. Now I'm trying to solve this one. So the question I'm asking is, okay, I enter at $17. And so when I make my plans, I need to make a plan for what happens. Either it goes up or it goes down. If I start losing money, at what point do I exit the market and cut my losses and crystallize and realize my losses, and then limit and create a situation where I don't have any more losses because the position is already fully closed down. So what is that point that leads me to do all that? Now that's the question I have to answer. Because when I enter, I should also place a stop at that point. So now let's find out, let's ask Sonal, where should that point be? Can you tell me? Yes, Sonal is not able to hear us. Okay, let's ask Gagan. What happened? None of these people can hear me. I hope people can hear me. People, you can hear
Yes,
me?
sir, you are audible.
Okay.
You are audible, sir.
Okay. So we have found out that two people are sleeping. Sonal and who else will we ask? Gagan. Okay, both are sleeping. Let's see who else is sleeping. Okay, let's ask Jakar. Jakar, can you help us? Okay, so Jakar is also sleeping.
No, sir, I'm sorry, sir.
Okay, you're there. Okay. So is my question clear?
Could you repeat this, sir?
Actually, your audio is very bad. Your audio is very bad. So we'll go to somebody else. 1 minute. We'll go to somebody else because your audio is very bad. Mitali, you're not on mute. You need to put yourself on mute. Okay, let's ask Aman.
Sir, I am on mute.
Okay, but it's not showing as okay now. But there's another thing that you have, which is not on mute. I don't even have a mute option. There's another Mitali Mittal, but that is not showing as mute.
Sir, I haven't connected my audio from that device, therefore it is not showing.
Okay, no problem. No worries, no problem. Okay, so let's ask Aman about this. What is the so Aman?
Sir, which Aman? Aman Agarwal, Aman Budhiraja.
No. Aman means Budhiraja. You should already be clear.
Yeah.
Aman Agarwal.
Yeah.
Aman Agarwal is a battery man, the double A.
Sir, we will set up. Okay.
So is my question clear?
Yes, sir. We will set up the stop loss near the purchase price.
Near the price. I mean,
Yeah.
this is near the purchase price. My question is very clear. One sec. I have already decided. I decided my buy-sell bias. It's a buying bias. Then I came to DP5. I have been told to decide it always as market price. So I'm going to enter at 70. Now I need to decide where should my stop be, because that's the point where I get out of my position and cut my losses. Okay, exit with loss. What should be that point? That's what I'm asking you. Hopefully you can read the numbers on the scale. Can you read it, Aman? 11, 12, 13, 14.
Yes, sir. Yes, sir.
Now to give me an approximate number of, you don't have to be exact because you can't use the cursor, but approximately where do you think the exit price with where do you think the stop should be? How many dollars? Is it at $12, $11, $13? Based on what I've taught you, based on what I've just explained to you, as to which highs and lows I'm considering. High, here, this one, these lows are here, here, and here. Now, based on what I've shown you, now you just tell me what is the figure where approximately where my stop should be?
Sir, around 13 and 14.
About 13 and 14. I mean, how can you have, like, You can't have around 13 and 14. It has to be one figure.
Okay.
It has to be
Sir,
one.
I'm not maybe right. Maybe I'm not right. Maybe 14
No, no, no,
is
no.
in my, I
You have
think.
not understood. One sec. Aman, maybe you're not paying attention. You have not understood this point. Okay, you listen.
No, sir, I'm here only.
No, no, you're
Can you
here.
repeat it again?
You may be there in body, but you may not be there in mind. So for whatever reason, you have not understood because we have already had the
I'm a
discussion.
little bit confused now.
Okay, we have already had the discussion. Okay, let's ask Shubham. Shubham, is my question clear? Okay, so Shubham is also asleep. Now, not only that, he has joined late. He has joined very late. Okay, let's see who else can we ask. Okay, we'll ask Krish. You have a question or you want to answer?
Sir, I want to try the answer.
Okay, tell me, what is the figure?
Sir, the figure would be in my scenario. It would be in 15.
Okay, so Krish says it's 15. Okay, we understand. We have 3 more participants who have raised hands. Okay, let me see. Where are the participants who have raised hands? Okay, Krish is one. Mukul. Okay, Mukul, you also want to answer.
Yes, sir, I want to answer.
What is the answer?
Sir, I will go for 15.75 approximately.
Okay, why 15 points? Let's zero in on what your area you're referring to. 15.75. 15.75 is somewhere here.
Yes, sir.
Is that what you're saying? Is that where you're?
Yes, sir. So actually, I'm considering that it is going long-term uptrend. Considering that, and but the days like the last this downtrend was around like I say like 12th September, 12 to like between 8 to 14.
Okay. All right, fine.
So I
Okay,
will go with this one.
you go with this one, okay. And then we also had Vipul also had raised his hand. Okay. Vipul, yes, you also want to answer.
Yes, sir. Sir, before answering, sir, I want to confirm one thing. Sir, you are asking for the exit price.
Correct. Exit with loss.
Exit with loss, sir. 16.445, sir. Something around 16.45.
You are talking about this low.
Yes, sir.
Okay. Okay. All right. Okay. So we'll stop here with the responses. Okay. So I'll just explain now what I meant. Okay. So in this case, given the information and the constraints that I gave you, okay, given all that, we'll go back to 3 months. Okay. Given all that, maybe we can go. Yeah. Okay. We can go and look at this also. Now we need to actually because some other people have given different answers. So given the information that I gave you, actually Krish's answer is the correct answer because, but all of you have got, Vipul and Mukul also have understood the idea that a stop, when you're going long and you're going long always at market, you're always trading at market. When you're going long, the stop will be lower than the entry. So Vipul said here, Mukul said here, and Chris said here. So all the 3 of them are correct in their understanding of the stop order, which is placed as a protection against unlimited losses. And that stop order is intended to sell out the long, square out the long position by selling off the entire position at a certain trigger. So this is the trigger for Vipul, this is the trigger for Mukul, and this is the trigger for Krish. So when they place the stop order with these levels, or just below these levels, so what they should actually do is read off the actual value from the chart. Here you can see the values. Read off the value from the chart. So if the actual value is say 14.75, then Vipul should place it at 14.74 because the tick size in the US markets is 1 cent. So you should place it at 14.74. So that means 14.75 is broken and then he wants to get out. So he will place a sell stop at 14.74. All of them are going long at 17. So the full stop is 14.74. Mukul is just below this and Krish is just below this. Now, so in that sense, all 3 of them are correct that when you're going long, when you're going long at market, the entry price at or in general, the stop for a long position is always below the entry price, and the stop for a short position is always above the entry price. So if I have GE and if I go short on GE here, if I'm going short on GE here, my stop would be somewhere like here as one example. So the stop is now higher than the entry price, okay, because it's a short position. We go back to FCX and we explain why Krish's answer is correct based on the constraints that I gave you. What did I say when I gave the lows and the highs? Remember that locking down the zoom level is very important. As human beings, because our brains are so visual and so complex, capable of handling complex tasks, we look at multiple time frames at the same time. But now, when you are using these kinds of visual cues to take decisions for a trading system, you have to be very careful. You need to lock into one zoom level only at a point of time. Otherwise, you'll get confused. So I locked you in. I initially locked you into the pattern size because I said, don't look at all these things. Don't look at all this one. Just one line here. Low. Actually, the low is actually a little bit behind. But low, let's assume it's here. Low, high, low, high, low, high, low, high, low. I deliberately said, don't look at all these small lows and all that, okay? Don't look at all these small lows here. There's also small lows here. Don't look at all that because I'm locking you in highs here, 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 and here. Lows here, 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 and here. That means we don't consider these lows. We are not zooming in that much, okay? This is the maximum we are zooming in. So the answer should have been given in the context of the constraints that I had placed on you, okay? So that's why Krish's answer is correct, because what do you do here? You decide, remember we discussed this, all right, where Utsav had a clarification. Initially it was sounding confusing. Whenever you look at the English, when you look at the language, it may always seem confusing. If you look at it,
Sir?
Yeah.
Sir, I want to ask one thing on that graph. Sir, can you show it? Sir, you have asked the question for the loss at which we have to exit. And sir, there may be assumptions like of the volume in which Krishnandan traded and the volume at which Mukul has traded and the volume at which...
Interrupt you, don't keep speaking. Okay. Loss at which, whatever you said, that was not correct. You have to talk about the price, the stop trigger price at which we will exit with a loss. So,
yes, sir.
yeah, because obviously now we are talking about, I have to train you to talk, properly in a business context. So even if one comma or semicolon is out of line, I'm going to correct you. So this is what you should have said. What we are talking about is the stop trigger price. When you place a stop order, the system will ask you for the stop trigger. Okay.
Stop loss.
Yeah. We don't use stop loss actually. We don't want to use stop loss when you're talking about system orders. If you go to, you'll see. You should study all this on your own. Let me just. Now, stop order you'll have, basically you'll see, you can read all the information from the IB. This is the IB hyperlink, okay? But I've given you the instruction. Stop order has one parameter, okay? When you try to enter a stop order, the system will ask you, essentially the system is asking you for the stop trigger. What is the stop trigger? And so that's what we are asking. At this point, we are asking the stop trigger price below which or at which, on the break of which, we will exit our position with a loss. That's what you should have said. Okay, sorry. Now go ahead and repeat your question.
Sir, so sir, according to your constraints, sir, suppose sir, I made an assumption like I have traded quantity 1 lakh quantity in the stock.
Mm-hmm.
So sir, I don't want to incur $1 lakh loss in the same stock.
So that's
So,
okay.
sir,
I understand, but I'm not saying that the choice of is universally wrong. Okay, the choice of this level is not universally wrong. It just means, but in the context of my specific question, it was wrong because I had locked you into this was the maximum zoom that I allowed you to do. I was not asking you to look into such small patterns.
okay, sir. Okay, sir. Now
Both
I
your
got your point, sir.
answer and Mukul's answer is also correct, would also be correct if I had not put this pattern size constraint on you. Okay, because I told you, so if I had not put that constraint, then Mukul is using a slightly bigger pattern than you, than Vipul, and Krish is using a bigger pattern than both Mukul and Vipul. So in that sense, all three are correct. But in the context of the constraints that I had applied, I said, don't look inside this movement. Don't look inside this movement. Okay. So I had locked you into a minimum, I had locked you into a maximum zoom level. So that's why Krish's answer is correct and Mukul and Ripul's answer in the context of my constraints is not correct. Otherwise, in general, they get the flavor of what has to be done. Okay, is this clear to everybody? Yes.
Yes, sir.
Aman, are you clear now?
Sir, I didn't really get the constraint part, like big,
Yes, sir.
like how the thing is that it kind of went overhead. Sorry for that, sir.
No, that's okay. You don't have to be sorry because it went over your head, but you have to pipe up because
Yes,
now
sir.
I'm poking you and then you're actually you should have told me initially on your own that I didn't understand. Please explain it again. Okay. So now what I meant by constraint was the constraint was in terms of you understand zoom, right? Zoom, here we have a certain zoom. Now if I want to zoom in more, it already says zoom in. You look at this chart, it already says zoom in. If I want to zoom in, I'm zooming in more and more, right?
Yes, sir.
Okay, now you understand zoom in, now you understand zoom out also.
Yes, sir.
Okay, so what I had done was basically I had said that I am locking you into if I say maximum zoom, that means in the maximum zoom, you
All
can't,
of the chart, most of the chart.
no, maximum zoom level, that means you can't zoom anymore. You're not allowed to
Okay.
zoom anymore, right?
Okay.
Maximum,
Yes, sir.
can't zoom in anymore.
Yes, sir.
In. I should have said maximum zoom in, zoom in. So I said, don't look at these small patterns inside, like inside this pattern. Don't look at the highs, lows inside this pattern. Just look at these highs and lows. High here, low, high, high, low, low, and low. Okay. I did not ask them to look at lows like this one, smaller lows, because I said this is too much of a zoom in. I don't want you to zoom in more than this zoom in level where you can see only these things. Got it?
Okay.
For instance, when you look at 1 year,
Hello?
yeah, yeah,
Hello?
can you hear me?
Yes, now I can hear you. Yes.
Okay. So that's what I was talking about. See, this is a daily chart. Earlier we were looking at an intraday chart. On a daily chart, now you understand what I meant. Now
Yes,
Krish
sir.
is actually here. So Krish's chart is such that essentially I was locking you into a daily chart zoom for this case. I said don't go. Now you can see inside this, you can't see any of the lows also because the daily chart is not even visible. It looks like a straight line. So that's why I was saying that you have to do this for yourself also, otherwise you will get confused.
Okay, sir.
You can lock into it. You can use any zoom level. Essentially, as I said, you can decide your 2 time frames. You can have 1 month as one time frame, larger time frame, and then you can have 5 days for the project. Okay, so 1 month at 5 days. So basically, 4 weeks, and this is 1 week. So try to have some distance between the two. Okay, don't make it like 5 days and 4 days. That's too close to each other. But you can have any two. You can have any 2 time frames. But what I'm saying is, once you have decided your 2 time frames, don't keep zooming in, zooming out, lock into that zoom level, lock into that zoom in level. Otherwise, you'll get confused.
Okay, sir.
Okay, that's all I'm saying. So, what we are trying to do here is we are trying to solve this DP 6.2. So, Aman, is it clearer now?
Yes, sir.
Okay, so you have to read these notes. I think you're not reading enough or not reviewing the material enough. So that's why you're not clear about these things. So these are all important decision problems, and I'm giving you some very simple rules, but these are very solid rules. You can actually employ them in the real world with real money, and you will be quite well
Okay, sir.
you'll be quite well protected. Okay, so make sure you understand this.
Yes, sir.
So for stop orders, we have already discussed. You can listen to the video for yesterday. We have already discussed this logic in extensive detail. Why is Krish's answer correct? Okay. Okay, so in terms of the zoom level, and Mukul and Vipul are also correct in general terms because they are looking at smaller patterns. Okay, but let's just take Krish's answer. Why is his answer correct? What is the logic that he went through? The logic he went through is what we discussed yesterday already. Now, you are going long. You're going long on FCX, which means you're buying FCX shares and you're selling dollars. Remember, every transaction, these are all in your notes. You have to read the notes. Every transaction is a contract to exchange assets. When you buy FCX, what you're doing is you're entering into a contract to buy, let's say you do only 100 shares, one lot, okay? To buy 100 shares of FCX and to sell $1,700. Okay, so if you buy it at 17, so you will sell 1,700 US dollars and you will buy, you will sell 1,700 US dollars and you will buy 100 shares of FCX. That is the transaction that is being, contracted for. Okay, understand that. Theoretically understand what it means to do a transaction in a financial market, where it's a contract to exchange assets. All of this is in your notes. All this theory there, you must understand this theory. So it's a contract to exchange assets. So there are always two assets involved. Here, these are trading in US dollars. So you are buying FCX shares, selling US dollars. Now, what happens is basically when you're buying dollars, and then you have to also take a decision as to one of the decisions you have to take is this exit price with loss. When I buy FCX, and then if the price starts falling, at what point do I exit my position with a loss? Because I need to cut my losses. So how did Krish come up with this decision? All right. Now, what did we discuss yesterday? When you're buying, okay, why did you buy? We took the example of, let's say we are discussing a momentum traders example, but the logic will remain the same even for mean reversion. We'll come to that logic. Today we'll just spend a little more time also on the mean reversion traders logic. But first, let's quickly recap so this part is actually repetitive, but we can see, as we can see, that some people have not understood it clearly. I'm sure there are many more. We just happen to catch Aman, but many more if we don't, if we catch some other people also, they may not have understood. And so the idea is, the logic was already discussed yesterday, that you have gone long. What does it mean? If you go long, that means you believe that the uptrend is going to keep on moving higher. Okay, so the uptrend is continuing. And remember, we have in our notes that we have for the cyclicality section, cyclicality of prices, we have described the conditions for maintaining and starting and maintaining uptrends and downtrends. Now you have gone long. From that, we can understand that you believe that the uptrend is still in progress. It is going to keep on moving higher. So now the general principle, if you see what I have written here in your 6.2, the general principle is that based on your assumptions, the general principle we apply is, we already discussed this yesterday. If an action, all right, let's say after After an action, these are very general principle, okay? This you can apply in areas outside trading also. Very common sense, but we are still stating it because we want to be very, very logical. We want to understand all the assumptions, okay? All the logical steps. After an action is taken, or maybe after is not sufficiently clear. If an action is taken, the action is only taken based on certain assumptions, okay? Is taken based on, we'll just take one assumption at this point. If an action is taken based on an assumption and then we find out that the assumption is not or invalid. Okay. The assumption is not true. The assumption is not invalid. This is the general principle. Then we should reverse the action taken. Okay. Very common sense stuff. Okay. We should reverse the action taken. If you take admission in a business school and then you obviously you took admission because you thought it was a good business school. Then if you receive some information which tells you that this is not a good place, this is a bad place, you should try to exit from that decision and withdraw from that institute and look for a better institute. So the general principle which you can apply everywhere. Okay. So this is the same principle that we are applying to the selection of the stock. Okay. So no, I'm not going to keep asking every time, but you have to make sure that if anything goes over your head, anything that I say that you don't understand, even a comma or full stop, you have to interrupt me and ask questions. We see that only a few people in general ask questions in the class, but it does not mean that others are not are always 100% clear. So I think probably either you're a little bit too relaxed or maybe you're feeling shy about asking questions. So don't do that because you're the one who will lose out. Spending time in the class, you need to make sure that you understand what is being discussed. Okay. All right. So this is our general principle that we are going to use for selection of stops. Okay. Now I'll just explain the English and then we'll do the notes later. I'll explain in English. We have already discussed this yesterday. So I'm going long as a momentum trader. I checked both my time frames. We have uptrends on both time frames, so I can go long, and both the uptrends are intact. So I go long. DP5, we are always choosing the market price option at the moment. So I go long at market $17. Now I need to worry about what happens if the position keeps on losing money, right? In that case, what do I do? So I need to have a plan from before as to the stop trigger price below which I will completely exit my position. And so the question is, DP 6.2 essentially deals with this. Where should that price be? Where should my exit price with loss be? What should be my exit price with loss? That's the question we're trying to answer. And as Krish pointed out, it's over here. Okay. All right, we can zoom in a little bit, I guess. We have a better idea. Okay. Now, why is this the correct answer? What is the logic that Krish went through in his head? First, he sees that we are going long. If we are going long, that means that our assumption about the state of the trend is that the trend is incomplete. This uptrend is incomplete. That means it will keep on extending higher and higher, okay? Making new and higher and higher. If it goes, then we go back to our cyclicality note and we talk about the properties of trends and we say what is the condition for starting or what is the property of a trend? It is higher high of a property of an uptrend. Higher highs, higher lows, okay? So therefore, if we are saying that the uptrend is going to continue moving higher, that means I should continue to see, just like we saw here, high, high, all these high, they're all higher. Subsequent highs are always higher, okay? HT plus 1 higher, greater than HT. So, and then LT plus 1, same thing, greater than LT. This pattern, I should continue to see this pattern. That's what I'm saying. If I'm saying the uptrend is incomplete, that means I should continue to see this kind of pattern. So when I project forward 6 months, say, or 3 months or whatever, I should see more and more patterns like this, higher highs, higher lows. That's what I should see. That's my assumption. Because I'm buying it, so it means I'm going long. That means because I want to make money, the only way I can make money is if it keeps on moving higher. So that means because I'm buying, it automatically means that my assumption about the trend is that the uptrend is still incomplete. It's going to keep on moving higher. Right. Now, where do you exit the position? General principle? Yeah. What is my action here? My action is to buy FCX. What is the assumption here? The assumption is that the uptrend in FCX is going to keep on moving higher. Okay. Now, obviously, I should, if I find out the assumption is invalid, then I should reverse the action taken. That means I should sell my position. Now, when will I find out that my assumption is invalid? My assumption is that the uptrend is incomplete. It's going to keep on moving higher. Now, if the uptrend is neutralized, then obviously it invalidates my assumption, because a neutralized uptrend, you can no longer say that it is still continuing. Okay. So the moment the market gives me some indication that the uptrend is neutralized, immediately I know that there's something wrong with my assumption. Because what did I say? I said it's going to keep on moving higher. What does an uptrend look like? Higher highs, higher lows. Now, if the market makes a new low, that means the pattern of higher lows is broken. And if you go back to your theory note on cyclicality, the condition for maintaining an uptrend is the sequence of higher lows. So now the market has just destroyed my condition for maintaining an uptrend. So we say this uptrend is neutralized. So if the uptrend is neutralized, how can you say that your assumption about the continuation of the uptrend is correct? It's obviously been proved to be wrong. Is this clear to everybody at this point? Yes, Rajat, are you following the discussion?
Sir, please can you repeat the point once again?
Okay, so which point? I mentioned a lot of points.
Sir, the last one you mentioned, like that you were showing 15.14. Sir, I don't understand what you were trying to say.
No, up to which point have you understood? Have you understood the point where I'm saying that if I'm entering a long position, that means my assumption about the trend is that it's going to keep on moving higher? Is that part clear?
Yes, sir. Yes, sir. Sir, sir, when you said that it is going that it is showing uptrend, so where sir, why Krishnandan point was correct that 15 should be the stop loss position,
So,
and you mentioned
yeah. So what I'm asking you is that you have understood up to this point that we are getting into a long position because the trend, we are assuming that we are trading from the momentum side. So we are entering a long position because we see intact uptrends on both short term and long term. So we are allowed to enter a long position here now. Okay. So
yes, sir.
DP4 is decided in favor of buy, not sell. Then our DP5, we have already told you that always assume market price based entries. So we know that as well. We are entering at 17. Okay. Now the question is DP 6.2. Where should we exit with a loss? Because we need to have a plan for that. Okay. Because otherwise it may keep on losing money and losses may keep on increasing if the price starts falling. At what point do we exit the position if the price starts falling? Now here we said, now you have also understood this point, that so the way we decide, now this is what you have to understand, that the logic through which we come to the solution here for 6.2 is very simple. You agree with the general principle which I've written here? You agree with that? Yes, Omar?
Yes, sir. Yes, sir.
So this is all that we need logically for this, and then from this itself we can solve the solution, or we can come to the solution. What is,
Yes, sir, sir. The assumption point that when you said that Krishnandan has assumed that like 15 should be my stop loss point, and you were explaining something.
yeah, no, no, he has not assumed it. He has arrived at the solution through the application of logic. What he's assuming is that since the person is going long, then we can make, by looking at what a person does, whether he's going short or going long, we can make an assumption about their view on the state of the trend. Is this statement clear to you? What I mean by this?
Yes, sir. Sir, that the person has chosen, sir, about the DP4 that he has make buying bias decision. Sir,
Yeah. So, no.
uh, uh, s- so on the basis of this decision, he's making an assumption that that he will. Sir, I am not getting it.
So this part you're not clear. This is what we have to be clear about. So this, when I'm explaining all this, people have to ask. It's good that you have asked a question. I'm sure many others also may not be clear, but they're not asking questions, so I can't figure out who is clear and not clear. But I hope everybody is paying attention. You have to understand these are all conceptual and these are completely logical. Once you study it properly and revise it and you understand it conceptually, you will see there's nothing to memorize. Everything is logical and conceptual. Okay, some very obvious principles like this, general principle like this, which everybody understands, common sense, we will come to the answer without having to memorize anything. So if basically what you have to understand is what question to ask at each step, each logical step. So here we decide, okay, this guy is going long. What does that mean about what he believes about the state of the trend? Okay, you can either believe that the trend is over or you can believe that the trend is not over, right? So this guy obviously believes that the uptrend is not over. Otherwise, why is he buying? Obviously, everybody wants to make money, right? So if he's buying, and we know everyone wants to make money, does he make money when the price goes up or when the price goes down? Yes, Omar?
Sir, sir, the price goes up.
Correct.
Sir,
So
when it's fine.
yeah. So when if you're buying, then automatically you know that this guy must believe that the price is going to keep moving higher, right? That's why he's buying. So that's a very obvious thing. And so now we want to get a little more precise, okay? And we want to talk about what are the properties. You have understood this point about the properties of an uptrend, higher highs, higher lows. You understand that? It's visually,
Yes, sir.
it's visually you
Yes, sir.
start to see that. Okay. So that means what this guy believes is that this pattern of higher highs, higher lows, which we are seeing so far, this pattern is going to continue. That's what he believes. That is his assumption. This is clear? Right.
Yes, sir.
So now we come back to the general principle that if your assumption based on which you took the decision, so he assumes that this is going to happen. That's why he goes long. Okay. He assumes
Yes,
that
sir.
happen as well. So the general principle, as I said, if the assumption breaks down, then you should reverse the course of action, right? Assumption, if it breaks down, then you reverse the course of action. Okay, that's the general.
Yes.
Now, when does the assumption break down? What is the condition? Because the assumption is that the condition is, I think you're not spending enough time doing the readings and revising. That's why things are not clear. Okay. You have to go through the notes, read the notes. If something is not clear, you have to tell me, then I will rewrite the notes. Okay. So, but for that, you have to first read the notes and follow the videos, revise from the videos and the notes. Okay. Now, what is the assumption is that the uptrend is going to continue, which means we should see a continuous pattern of higher highs and higher lows. But, and so what destroys that assumption? The moment you make a
Sir,
low,
if the
yeah,
sir, the assumption will be destroyed if the uptrend doesn't follow, if
yeah,
the price goes down.
yeah, the price goes down, and very specifically, you have to now go back to your cyclicality note and you will see that we have given a condition for maintaining uptrends and downtrends. The condition for we are talking about an uptrend here. So the condition for maintaining the uptrend is higher lows, right? All the lows must LT plus 1 must be higher than LT. Wherever you look at two lows, LT plus 1 must be higher than LT. LT plus 1 must be higher than LT. Are you following what I'm doing?
Yes, sir.
LT plus 1 must be higher than LT. Any two lows you look at, the second low, the later low must be higher than the previous low. That is the way you maintain an uptrend. So if we are asking ourselves, at what point is the market telling us that our assumption is destroyed? Our assumption is that the uptrend is intact, it's going to keep on moving higher. So as soon as we get a lower low, then our assumption is immediately destroyed, because now we can no longer see higher lows. That's the condition for maintaining an uptrend. Are you following? Yeah.
Yes, sir. Yes, sir.
I'm continuously asking Ummat because she has asked the question, but actually she should not feel embarrassed about it. But I'm actually using her as a representation of the whole class. So when I'm asking her, are you following, means if Ketan has not followed also, then Ketan also has to respond, saying that I did not follow. So Ummat is just being used as a proxy for the whole class.
Sir, I followed.
Yeah, good. So we are talking about zoom levels, so you have to follow. You're the photographer. So, okay. All right, good. So now let's see. So is this point is clear that you just have to now go back to your theory. Condition for maintaining uptrends, higher lows, okay? Sequence of higher lows. The moment you break this pattern of higher lows, which is the moment you break below this point, okay? Visually you can see that the moment you break below this point is when you have the break. The pattern of higher lows is destroyed. The moment you break below, the market breaks below this point, that's when the pattern is destroyed. Is that point clear?
Yes, sir.
Okay. So that's why, so therefore, this is the point where you get the first indication that your assumption about the continuing uptrend is destroyed. This is the first point you get the indication. So as soon as you get this indication, you want to get out of your long position, because now you can no longer justify your long position. You could justify your long position because you made an assumption that the uptrend is going to continue. Remember, you're a momentum trader. So as a momentum trader, when you look at a trend, you automatically assume if the trend is intact, okay, the intact uptrend. So the two things, you look at a chart, you look at two things. You first notice the trend. Highest price is made later than the lowest price. So this is an uptrend. Then you look at the highs and lows, lock into a zoom level, lock into a maximum zoom in level, and look at the highs and lows. Here I say one low, low, here low, 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 here low, and low. Okay. Lock into this and see, is the trend intact? At this point, it is intact. Okay. So you automatically assume as a momentum trader, because there's an uptrend which is intact. So you assume that this uptrend is going to keep on moving higher. Okay. And that's why you buy. But then you need to have a backup plan for your losses. And that's where you put the stop, which is to exit your long position, because once this low is broken, you can no longer say higher lows. Okay, you have a lower low. Then the assumption of the condition for maintaining the uptrend is destroyed, because the pattern of higher lows is broken. So if your assumption is destroyed, we can no longer say the uptrend is intact. Your assumption is destroyed. You cannot justify. I just finished it. So it's 12:45. Okay. I'll just finish in 2 minutes. I will not hold you back. Okay, so we at least have to understand the stop logic, and so as soon as your assumption for you no longer can justify your long position, that's why you have to close out your long position, because justification is destroyed, uptrend assumption is violated. Okay, so therefore you exit, and that's why Krish will look at what he will do is he will zoom in here, find out, read from here what the low is. Okay, I think this is the low point and it's coming out to be 15.15. So he will place a stop order, sell stop order. What he will do is he will place a sell stop order at 15.14, just below 15. Okay, so that means as soon as the market trades to 15.14, the system will sell out his long position. That's what he's doing. Okay, so you guys make sure that you go back and revise this for short positions also. Understand what we have covered today is the stop logic. Okay, read this note. I will reorganize this note also better. Okay, I've given you some clues here which we discussed, but this is the general principle. Follow this logic, and make sure you understand this also for a mean reversion, for the mean reversion entry which we discussed. Okay, so I'll just briefly tell you what it will be here. We discussed Procter & Gamble, not one of your tickers in the project, but clearly aggressive mean reversion, the classical mean reversion approach. The guy will go long, guy will go short only on a neutralization of this uptrend. First neutralization happens on a break below this low, lower low, first time, September 4th. Immediately the guy goes short. In this case, his stop, his 6.2 solution is going to be at this high, just above this high. Because when he's going short means he's assuming a new downtrend is going to start. And as soon as the market makes a new high, that assumption about a new downtrend is completely destroyed. Okay, so his assumption is invalidated here. Make sure you understand this for yourself. You don't have time to explain it. I've already taken 2.5 minutes. So I'll let you go now. You do it on your own. Okay, revise the stuff. Otherwise you will not be clear. Okay, all right, class is dismissed. If you have a question, you can stay back. Otherwise, we are done.
Thank you, sir.
Okay, welcome.
Sir, I have a question.
Thank you, sir. Thank you, sir.
Yeah.
Sir, related to project, sir.
Yeah, go ahead.
Sir, as I have asked earlier about the sir evaluation of the project.
Okay.
And sir, sir, I have a confusion like, sir, if some of us is, sir, investing a very small amount of money.
Okay.
Suppose sir not investing a lot.
Okay.
And sir, actually, and sir, if he or she is earning everyday profit.
Okay.
Like, sir, $20, $30 every day. And sir, there is no sir, a loss, or we can say, sir, there is no down turn in the graph.
Brought out.
Sir, how will it will be a sir fair evaluation, sir? Because sir, if someone is investing a lot of money, and sir, he will definitely get a high loss.
No, see, there is no free, there is no risk-free option anywhere. Okay, there are two ways. I understand what you're saying. Some people may be trading in a very conservative way, very small positions.
Yes, sir.
But and so thereby they will reduce the. So there are two elements to the return, which is the numerator and the denominator. Okay, so what you're saying is that the numerator will be low. Okay. But remember that the starting point for everybody is the same. It's $1 million. Okay. So if you trade very small positions, it is true that you are able to control the denominator. You've got to keep the denominator low. Okay. But
Yes, sir.
it's also true because remember you're starting from. Everybody's assumed to be starting from a low base, from a around $1 million kind of base. So what will happen is if you have small positions, you will be able to contain the denominator, but your numerator will also be low. Okay? Your numerator becomes low because the base is fixed at 1 million. And if you trade small positions, your absolute total profit is going to be low and so your return on the 1 million is going to be low. So it's not like those who are doing this and trading small positions and reducing the denominator, they are not getting any kind of a free ride because they are getting hammered on the numerator. So it's a double-edged, it's a tight balancing act. You don't get an easy option anywhere. Okay, so if you try to keep this low, then this becomes a problem. Okay, then this also becomes low, and then your total ratio will go down. So either way, so if you are trying to keep this low, you have a loss. You may feel very good about the fact that you have kept this low, but you are also suffering because you are not. You're also suffering because you are not maximizing the numerator. On
And
the
sir,
other,
one more doubt, sir.
yeah, on the
Sir,
other,
yes, sir. Suppose, sir,
let me come.
like, sir, on the first day, sir, I got a loss of $10,000.
One minute, Vipul, one sec.
Yes,
When I'm interrupting, you have to stop talking. Okay. And at the same time, on the other side, if somebody is trading very aggressively, they are boosting the numerator, hopefully. Okay. They are hoping to boost the numerator. They're trading big position, but they're also taking a risk that the drawdowns can also be very large. So by using this kind of a ratio to evaluate returns, the performance in the project, we are not allowing anybody to have a free ride either. So there is no easy option anywhere. Okay, you try to do one thing and then the other thing also. If you try to score, if you try to maintain a high run rate, you may lose a lot of wickets. If you try to protect your wickets, you may end up with a very low run rate. So it's just like other areas of life, as in sports also, there is no easy option. You try to follow one strategy, you think you're being very smart, but then you're getting hit on the other side. This is clear. Vipul.
yes, sir.
Okay, go ahead.
Yes, sir. Sir, actually, my question is, sir, suppose on the first day, sir, I get a loss of $10,000.
Okay.
Because, sir, I am playing a very long, in a high position or very aggressively. And, sir, after that, sir, I start investing in a smart way. And, sir, at the end of the project, sir, I am able to recover all of my losses and a profit of, suppose, sir, 5,000. Hello?
Yeah, go ahead.
Yes, sir. So, sir, is it a good response according to you, sir, or a bad one?
No, see, it's not like good or bad or anything. Let's say if we start with one. Okay, this is your $1 million. Okay. Now, suppose you make a profit of 5,000. You're saying you're making a profit of 5,000 at the end of the project, and your drawdown is 10,000. Okay. So in this case, what we do is your CAGR is going to be computed as, okay, this has to be the terminal wealth relative, which is basically your CAGR is 1 million plus 5,000, okay, divided by 1 million. Second bracket. Okay, minus 1. All right. And so your return is 0.5%, which is 5,000 return on this. Okay. But we want to write it in this more complex formula because we should understand how to do the formula for any kind of a period or any return. Okay. Now that's your numerator. And what is your denominator? Your denominator is basically
Sir, minus 10,000.
yeah, no, that's not how it will be written. It will be written as 1 million. We should actually maybe do 2 brackets. It will be written as 1 million minus the amount of loss that you suffered. That will be the numerator, okay, and that will be divided by the starting value. In both cases, the concept is the same, except that here, okay. So here, actually, again, this is also this has to also be put as minus, I think I put the second bracket here, the wrong place. Yeah, this has to be minus 1, okay? Right. Right, so your loss is minus 1%, okay? Minus 1% drawdown. So your ratio score is going to be basically these two, the ABS of these two. In this case, since you have a positive return, this is going to be your score. Okay? This is going to be your raw score. Now, the question
Okay.
is it good or bad? Well, we don't know. It's a relative score. It depends on how the other guys have done. So if, say, Saloni's score is maybe 0.75, then maybe Mukul's score is 0.95, then Shaurya's score maybe 0.45. So you're better than Shaurya, but you're lower than Varun and Saloni. So this depends on what the other people are doing. So I don't think there's any easy option here. First of all, if you start to go for the numerator, you are taking a risk that your denominator may become very big. If you try to protect this, as I told you, I mean, it's just like if you in cricket, if you try to score a lot of runs, you may lose a lot of wickets. Then if you try to protect your wickets, you may not score a lot of runs. So it's not like anybody's getting a free ride or an easy option, okay? And then eventually, and you also don't know what the other guys are doing, okay? So I would suggest, one of the problems I notice, Vipul, in your thinking is, I would suggest don't worry so much about all this evaluation. Now, these are not big things in life, okay? You focus on
Yes, I got your point, sir. But sir, I'm thinking because sir, I got the loss on the first day because of my aggressive investment.
that's
So that's why I'm concerned about this. So that's why I'm confirming.
No. What I would suggest is that you try to remove this focus. Okay, I think it's natural as students. We are all taught to be very competitive in India. It's natural to have a focus on the performance evaluation. What is my grade going to be? But generally, I don't think that's a very smart approach. I can understand why everybody has that focus because that's how we are conditioned in India. We are brought up like that. So I'm not going to fire you for having that kind of thinking. It's quite natural. But I would also tell you that that's actually a stupid focus, okay? Grades don't really matter. What matters is learning, and the evaluation systems are not perfect. So you may get bad grades, but your learning may be good. So for what matters in life really is learning, okay, not the grades. So try to do the project properly and try to maximize your learning. Grades are all, where you get minus, C minus or B plus. In the big scheme of things, nobody cares about all this. When you go to,
Yes,
yeah,
yes, sir. I agree, sir. I agree with you. But but sir, actually, sir, it's about if sir I am learning, sir, it means sir I can perform better.
yeah. So you focus on learning. So when you go to a company,
Yes, sir.
and work in a company and you're competing with other people, Piyush is there, Priya is there, Sachin is there, they're not going to see, okay, who got more grades. They're going to see how you talk. They're going to see what kind of results you can deliver. So in the larger scheme of things in life, whether you got a B plus or a C minus, these are all faltu things basically. Don't focus on all these things. These are not going to help you in life in a big way, and these things don't really matter. Okay.
Yeah. Yes. Okay, sir.
Okay. All right. Okay. So clear.
Thank you.
Okay. All right, guys. Are you? Does anybody have any other question?
Yes, sir. Sir, I had a question about an indicator. Like what you talked about volume, I could put up an indicator in TWS of volume, a change of rate of volume. So, like I was, can you put the uh, chart of Comcast,
Of which one?
Comcast or CMCSA?
Oh, Comcast. Okay. CMCS. Yeah. Okay. So let's
Uh,
1 year. Okay. Yeah, and let's
So I was looking at a very less time frame of 5 days or maybe 1 month.
rate of change. This is the rate of change of price. Let me see if these guys. I don't have the TWS open right now, but yeah, I understand. So let's have at least let's put the volume in. I'll just put the volume in one second. I'll just put the volume. Uh, let's see what do they have on volume. Volume, session volume, price volume, trend, on balance. So on volume, one of the indicators, if you want to use volume, one of the most popular indicators is on balance volume. Okay, you can use that, and volume oscillator is also okay, but this is a better technique. Okay, so we'll put that. Okay, and then we'll ask your question. Okay, now you tell me what is the question.
uh, like me and Gaurav were discussing about this indicator, and sir, I was also studying about that head and shoulder pattern. So
Okay.
when we move over to the time frame of 1 month, uh, I could figure out a pattern like that of an head and shoulders from September 8. There is one hand and then there goes sorry, there is one shoulder and there goes one head. So but when I was looking at a more smaller time frame, then also I could see the same pattern. uh, so sir, I was confused by this. And sir, also can we use this indicator, that rate of change of volume, can we use that to for the mean reversion philosophy? Like if there is a higher rate of change, then the trend may reverse.
Yeah, I mean, I have to look at that rate of change. What is the actual formula that they're using and what parameter you're using? Because I don't see that formula on this one. So, but rate of change of volume, essentially, I would assume that this is something to do with, obviously it's like a price rate of change, okay? So, yeah, if you're trying, I don't know where you see the head and shoulders over here, where September 8th, you're saying.
Yes, sir, the shoulder starts from here, then till
This is the head.
between 10 and 40, and then I see ahead. Maybe I was seeing it wrong then.
This is the head.
No, this is the shoulder, one left shoulder, and then there goes the head, and the right shoulder is not fully formed.
Where is the head?
So from 14 September to 21.
No, 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 no. This is not working out. Okay. This is not how head and shoulder works. Okay. Head and shoulder, you can see the pattern, idealized pattern from the chart school. Go to the chart school website where I've given you the link. Okay. So initially, yeah, I'm not able to see what is because I have not used that indicator. Okay. So generally, I would just use on balance volume. Actually, I don't even use volume. I just look at some average volume figure. I mean, I don't want to be in a low volume illiquid stock, but generally I don't use volume as an indicator because one of the things, but you guys are just learning, but when you start when you acquire a lot of experience, one of the things that you'll see is that the more indicators you use, the more there is a possibility of confusion. So for instance, if you just look at the pure, so I use just pure price charts, but I'm not expecting you to do that at this point. You will naturally explore for yourself. You have to learn the lessons for yourself. I can't tell you the lessons. Okay. So you have to, practice on your own and learn the lessons for yourself. But I would say for volume, you can use on balance volume. Okay. And you can read about this from the chart school website. Okay, if you want to use volume at all. So essentially we use on balance volume if you wanted to use as a oscillator, okay, as a mean reversion technique. What you would do is, let's say we go zoom out. What is the time frame here? 30 minutes. Okay, what we would use, the way we would use it is that we would say that if you see, you figure out the calculation of on-balance volume, it looks at the upside volume and the downside volume essentially. So what you see is that if you're going to approach this from a mean reversion point of view, it's going up. That means you want to be a seller, okay? Yeah, because you're a mean reversion trader. It's going up. You want to be a seller. The way you would use the on-balance volume indicator is, so you're using the volume as an input. what you see is that the price is making higher highs, okay? But the volume indicator is so far so good. Here it was pretty strong, but here look at this. This is what we call a bearish divergence. You can check out the other indicators like RSI and figure out what bearish divergence is. So all this is falling under your here. Okay, so under mechanical trading systems, mean reversion. Okay, so you have divergence indicators. Okay, these divergence indicators, there are many of them. Okay, and you can use the so you're in this part of the overall framework. And so what you would do is you would say that, because anyway, as a mean reversion trader, you're already suspicious of this uptrend. You don't believe in this uptrend. You want to go against it, but you want to have some confirmation. So what you do is you're looking for various types of indications that this uptrend is not as strong as you might believe by looking at the trend. So one of the indicators you find is on balance volume, okay, which actually should be applied only with daily data, because I'm not sure how this 30-minute volume is being used. So it is not correct to use it. We have to make sure that we use only, because the exchange will give you volumes only for a day. Okay, they will only give you volumes for a day, and I have to zoom in a little bit. When you use on balance volume, okay, you have to check the parameter also. Normally the parameter is for 14. Okay, normally the parameter is 14 day. You see that there is no indicator and there is no divergence at the moment that is being shown. So let's go back to the 30-minute to show you what divergence is. Okay, at least I can show you the idea of divergence. But in this case, you should always use it with a daily chart. Okay, not a week, not an intraday chart when you're using these volume indicators. So what you would say is, you don't trust the uptrend, looking for signs that the uptrend is going to turn around and start going down. And what you look at, you plot this oscillator. This is the oscillator, and this is how you use divergence indicators. So you find the price is making higher highs, but the oscillator, in this case OBV, the volume indicator, is making lower highs, which means that the volume here, this last move up to a new high, this is not being confirmed by the volume. The volume is, divergence means moving away. Okay, so we say that, okay, Gaurav is saying something and Khushbu has a divergent view. That means Khushbu does not agree with Gaurav's view. Okay, they are different. So here what we are saying is, the price is making higher highs, but the divergence indicator is making lower highs. Now this is called a bearish divergence, which this is actually telling us that this uptrend is likely to reverse. This uptrend is not as strong as it looks. It's actually likely to reverse because this is a sign of weakness. Okay, so this is the basic way you use your divergence indicator. So for volume, I would suggest you use on balance volume, and always make sure when using volume data, always use daily charts, because I'm not sure how they would distribute the data, because the data doesn't come out for 30 minutes. Always make sure you use daily charts. Okay, your granularity should be 1 day, because the volume data comes out on a daily basis. All right, and in fact, if you see, Comcast has already made a new high. I think if you stop all this, and there you can see there is no divergence there. Okay, look at all. Yeah, so it doesn't look like a hot stock to short actually to be seen. I mean, I'm just talking from a general point of view. Let's say it seems like it may have already, no, not yet, just about, I think just short of a new high. Okay, so maybe you have to check this, but I think visually this high is not yet higher than the previous high. So yeah, so is this clear? Does it give you some kind of clarity, Siddharth?
Yes, sir. And one more thing, like this is very clear to me. And actually, I got from a momentum perspective, I got long on the highest high it made. So now I'm losing money in this. And also like there are idealized chart on that website. So when I looked at Head and Shoulders, sir, is that the condition? Like the chart should form a very clear pattern, or like the pattern should be very clear for the for me to recognize. Like I was seeing Head and Shoulders on this, but you said that this is not so. So is that the condition for recognizing the patterns?
So although the chart school website is showing you idealized, it's not really idealized charts. They have cherry picked the pattern, but the charts are all actual. They have not drawn it. The charts are actual. Okay. So therefore, you can look at patterns. Those patterns are actually, yeah, the pattern should be fairly clear. Okay. It should not be something where you have, let's say, let's look at, I think I saw something on oil. Not really. Yeah, I thought I saw something somewhere. Maybe I think if we go into maybe 5 year, so I think this last move has actually destroyed everything. Yeah, I think I'm trying to remember where I saw a last Head and Shoulder kind of a pattern. But anyway, you can look at those charts and see those are actually just use the chart school notes. Okay. And what they have are those are actual charts. So the pattern has to be quite clear. There should not be any doubt about it. Okay, pattern has to be quite clear. Here also we don't have anything, so we don't see any clear indications. No, I should actually put this as USD JPY. Well, let's see. Oh, that's all they have. This is all the data they have. Okay, now this could be something. Okay, this could be something here. Let's try to use maybe. Yeah. Well, if you zoom in here, and try to zoom in here. Now this is not a, this is an inverted Head and Shoulders. Okay, let's see what we have. I don't want to put it in the center. Okay, here you see this bottoming in dollar yen. Okay, now here is what you would look at. Okay, if you just ignore this down decline here. Okay, you have a slightly better pattern, but you can include it as. So this would be your head. Okay, and this would be your shoulder. This decline here. This would be your left shoulder, this would be the head, and this would be the right shoulder. And this is what we call the neckline. So you can see slightly, not ideal, but still a little bit better than what you've seen so far. And this would be the neckline approximately. And then you have the breakout from the neckline. Are you following, Siddharth?
Yes, sir.
Gaurav, you're following?
Yes, sir.
Okay. So this is a better example, okay, so far what we have seen. So yeah, you have to keep looking for them, but the pattern should be fairly clear in the sense that what I showed you, I think pretty much all of you agreed that this is basically what it is. I didn't put the full. There's some activity happening in the UK. There's a trade deal with Japan, and then there's some activity on Brexit. So it is a little interesting to look at the cable. This is called the cable and see what is happening. Okay. You know, this would also qualify. See, look at this last part here. First is another thing to look at it. There has to be a down. There has to be a decline to reverse. If you're looking, these are all inverted Head and Shoulders, not actual inverted Head and Shoulders. So not proper Head and Shoulders, which is a bearish reversal. This is a bullish reversal, which is inverted Head and Shoulders. Now, if you just zoom into this part, there is already a long decline. Zoom in here. No, that's too much zoom in. Yeah. Here it would be somewhere, it is forming. You can see that it is forming actually. It is kind of forming, see? So what happens is, this is the head and this is the left shoulder. So this thing is the left shoulder and this is the head and this is the neckline. You see that price is turning down from this one level support, one resistance level where price is stopping once, twice and thrice. Okay, so this is the left shoulder, this is the head. Now, if you have a pattern in sterling where it starts to decline, comes up to here, and then again starts to go up, that would be the right shoulder. Okay, so the right shoulder starting from here, and it may trace out over the next few months and come here and then break out to the top. And here you have the left shoulder. Is this clear?
Sir, is it a good idea to have a position to buy or short while the pattern is forming, or should we wait for the whole pattern to form and then uh,
Yeah.
decide to buy or sell?
You should wait for the whole pattern to form. That is the answer. You should wait for the whole pattern to form. But you can already see here, if you are using, that is if you are using the pattern approach. Already you can see here that there is a break. Although there's no new high actually, so it's a little confused in terms of trend. If you see, this is what, 1 year. This is 5 year. Yeah. So there is a decline. This high is broken here, and there's a new low. Has this high broken? Has this high been broken? I don't think so. Not yet. Okay. So that would be another indication actually. So ideally you should let the right pattern shoulder form and then go on the breakout. To go long on the breakout. Okay. And that is the classical way to trade. Yeah. So here what I'm telling you is I'm teaching you how to bat in the classical way. So to play in the class. So it's like I'm teaching you how to bat like Dravid. If you feel confident you want to bat like Sehwag, then you can do it, but I would not recommend it initially. When you're initially learning the trade, you should learn the classical way. And then if you feel very confident, you can start batting like Sehwag. That is your decision later on. Okay.
Yes, sir.
All right.
Sir, I am doing the project like you told us to, but I am also learning other things, so I'm trying to apply it here also. So I was also learning about leading and lagging indicators. So sir, can we say that the mean divergence indicator are leading indicators like RSI because it shows us before that the trend is going to reverse?
Correct. They are leading indicators. But when you are using terms like leading, lagging indicators, you have to be careful that you qualify your statements by talking about leading and lagging technical analysis indicators, because these terms are more commonly used for economic indicators. Okay, these terms are more commonly used for economic indicators, like for instance, unemployment is considered a lagging indicator. The stock market is considered a leading indicator. Consumer confidence is a leading indicator. Okay. So if you use terms like leading and lagging indicators for TA, you have to qualify your statements by mentioning that I'm talking about technical analysis, not about economics. Okay. Because normally people would understand it. If you don't say anything, people will understand these as being economic leading and lagging indicators like unemployment, consumer confidence. You have to be careful about that.
Sir, if I'm looking at a news and I want to know if people are, if how people are reacting to that news, is it wise to see the volume trends? Because we do not have much time to see if how people are reacting to a news.
Yeah, you can see that. You can see that also. But the main thing you have to look at is price. Because remember, what you are trading is the price. Okay. So all these indicators that we have, none of them are 100% reliable. So yes, you can look at volume and see how volume is reacting, but mainly your first focus should always be on price because you're trading on price.
Okay, sir.
Price is the first reaction. Always notice. So one of the advantages of doing this kind of a project is that you get some actual insight into how markets behave. So that like what Siddharth was saying yesterday, that when you read the books and the things they will say, or even the commentary, they will say that if the earnings are good, then the stock price will move up. But when you see the real world, you see that that's not how it actually works. In the real world, there is actually no reliability. None of the rules have very good reliability, okay? In the sense that our understanding of the science of flight is perfect, okay? Thousands of planes are taking off every day and landing because we have cracked the science of flight. There's nothing new to learn, okay? There are certain problems in turbulence and all that, but by and large, takeoff, landing, flying, we have cracked it, and so it always works. But in investing, in finance and economics, there is no such guarantee. You can keep on slogging for 500 years and you will never find the perfect science. Okay, so you have to understand the difference between real science, and these are actually more like an art or a craft, like learning carpentry or learning something else, which is maybe learning how to paint or something like that, where so these are not perfect sciences. In perfect science, once you crack it, that's it. We know exactly what to do, and it will always work. So that's why I tell you to. That's why I make you guys do these projects where you get to see how real. Because these are not simulations; these are real prices. So you get to see how markets actually move, and you compare it to the news, like what Gaurav is saying now, like how the market is reacting to the news. So you have to observe all these events happening in front of you, and you have to form your own understanding of what the market is like. Like for instance, Siddharth is trading on momentum, losing money. Now he's trying to look at mean reversion. Okay, so these are the learning processes that you have to go through. Okay, you try something, it doesn't work, then you go try something else, and maybe you come back. You keep on experimenting like this, and that's how you eventually. So don't expect that you will get clarity immediately. You should expect to have some struggle and some confusion initially, but that's okay as long as you're pushing forward and learning and experimenting. As long as you're experimenting continuously, it's okay. That's fine.
Sir,
Yeah, yeah.
sir, I have a doubt regarding a stop order actually.
Okay, go ahead.
So what I understood is that stop order is basically a loss minimizer, like it reduces loss.
Yeah, well, let me just clarify that because if you remember, there is a reason why we said there is a discussion which we had at one point of time. It's there in one of the videos. Why do we say stop order, not stop loss order? We have already explained this once with FCX. Okay, so you can go back and look at the video. But the reason we always should say the classical way of talking about this is the layman's term, stop loss. Okay, the technical term is stop order. Why do we say that? Why not stop loss? We have
Uh, because we also sell it at a certain level of profit, like it won't go after high after this much, so sell it. That's why. And
no,
also
no, that's not correct. That's not correct. That's not what you said just now is not correct. Okay. What, let me explain. You can go back and check the videos. The answer is already there, but I'll explain it to you one more time. The reason we said, so the reason I objected to your statement initially, and I did not want to endorse it as 100% correct, is because, so we should not even use the stop loss now, unless somebody at work is talking about it and you have to just accept what they're saying. But the correct statement is always the stop order. Why? Because we gave this example. We said that Sachin went long FCX at $11, let's say. He went long FCX initially here as the new low was made, 1160. At that time, he placed his stop order here. Okay.
yes
So
sir.
if that stop order had been immediately triggered, so if the market had immediately dropped after Sachin went long, Sachin would have actually lost money. because going long at 1160 and losing at exiting at 975, losing money actually. Okay, but now many months have passed and Sachin has held on to his position, but he keeps doing the trailing stop. All this is there in the previous videos. You can go back and check. He keeps using a trailing stop. So now, as when the market moves up here, he can see that the highest low from which all is there in your notes as well. Check your 6.2 notes. The highest low from which, at this point, the highest low from which a new high was made was here. But when we come here, the answer to that question is no longer this. The answer to that question is now here. This is the highest low from which a new high is made. So Sachin will now move his stop. When the market comes here, Sachin moves his stop to here. Then he moves
Yes,
it
sir.
here, then moves it here, then moves it here. Are you following the logic?
Yes, sir.
So
As the new low keeps on increasing, he puts it at that stop.
yeah, because he's always asking, all this is in your notes, and what is the, so for a long position, now if it's short, you turn it around. For a long position, he's always asking, what is the highest low from which a new high was made, which is basically the point which maintains the uptrend. Okay, so he continuously asks this question, and now if you see, if this stop is triggered, now his stop is over here. Today his stop is over here, 1507. Now if it's triggered at 1507, the market drops below 15.
He's still making some profit because he bought it at some other price.
Yeah, he bought it at 1163. Now he's exiting at 1506. Okay, so he's actually making a profit. So that's why this should be called a stop order, not a stop loss order, because he's actually not losing money.
Yes, sir.
Now being used,
Because he bought the stocks at different price, at a lower price, much lower price.
so this is now being used to protect profit. Okay, but what is always true about a stop order is what is written here. Okay, it's always true about a stop order that whenever you're trading with a stop order, you're always, because assume that, let's put it this way. So Sachin comes back from holiday and suddenly sees that, okay, now the price has shot up to $17. Okay, he bought this and he went on holiday and he put it here. Now he sees it here. Now he puts a stop order at this point, 1507. Now, what is always true about a stop order is it will lead you to transact at a less favorable price compared to the market price. Okay. Let me write this here also just to be clear. More favorable and just to be clear, more favorable, less favorable. These statements don't make sense unless you clarify it is what is it relative to. More and less is always relative to something. Okay, like Siddharth has more than Varun, Gaurav has less than Shaurya. So it is always relative to something else. So relative to the market price. Okay, so more favorable, less favorable, these terms are relative to the market price. Okay, so what is always true, the way you should think of a stop order is, this is how you should think of a stop order. Then you never get confused. Okay, that a stop order is going to be either a sell stop or a buy stop. In this case here, it's a sell stop. A stop order is always going to lead you to transact. Execution of a stop order will always lead you to transact at a price which is less favorable than the current market. What is Sachin's position? Long. For a long position holder, isn't it better to sell at 17 than to sell at 1507? It's always better to sell at 17, the current market. But he is choosing to put a stop here, which means if it gets triggered, he'll end up selling at 1507. So it is always true of every stop order that if executed, it will lead to a transaction at a price less favorable than the current market. Notice I don't say lower, because that will be true only for long. I say less favorable, that will be true for shorts and longs. Is this clear?
Yes, sir. So it's basically a tool for selling the stocks at a less favorable rate than the market rate.
Yeah. No, don't say selling. No, transacting. Say transacting.
Transacting the stocks at a less favorable rate than the market rate.
Yeah. And then also don't say stocks. Say assets, because this
Assets.
if you are using this for trading commodity futures, then it's no longer stocks, but the stop order is the same. So you say selling assets, okay, selling assets at prices less favorable or less favorable than the current market. Now, don't say selling assets, transacting in assets at prices less than, because transacting is more general. It includes buying and selling. But if I say selling, that means I'm excluding buying. Okay.
Okay.
So we have to be very careful about how we talk, because that will affect our thinking and that reflects our thinking. So you have to think always in general terms. You should not think in specific terms unless there is a reason why you want to speak in. Unless you actually want to exclude buying, then only then should you say selling.
Okay. No, when I was seeing it in general, it was the stop order thing was generally applied for like selling. I saw the buy option as well, but I just saw it like it was not explained. After you explained it, I understood it.
So you have to always make sure you talk in general terms. That's why you have to be careful not to say selling the stock. You should say transacting in assets at prices less favorable than the market price.
Okay, sir. Thank you.
So we have stop order. Okay, we can actually, yeah, we can put this into the stop order part of it, and if it's not written here. See, sell stop is always below the current market. Buy stop is always, so this is basically it. Okay. Yeah, that is what. Is it clear now?
Yes, sir.
Okay. All right. Okay. Any other question?
Not from me, sir.
Okay. All right. So we are done. Then I will stop the recording. So good, we have all this stuff on recording, because then we have our sessions are actually the videos